You're listening to the Financial Source podcast on YouTube.
Welcome to today's deep dive. We are so glad you can join us.
Yeah, thanks for tuning in.
So our mission today is to unpack a really complex global market snapshot, one that's driven, well, entirely by escalating geopolitical tensions.
It is a volatile situation out there.
It really is. We're looking at how a 4-day conflict involving Iran is sending these massive shockwaves across global energy prices, currencies, and bond markets.
Leaving investors basically scrambling for safe havens.
Exactly. So let's unpack this by looking at the specific trigger mentioned in our source. The tensions involving Iran are escalating.
Right.
To lay it out impartially, the Islamic Revolutionary Guard Corps threatened vessels attempting to transit the Strait of Hormuz, and U.S. President Donald Trump warned of potential larger strikes.
And I mean, the so what for you listening is that this has triggered a massive energy shock.
Just a total scramble for resources.
Exactly. To put the magnitude into perspective, European natural gas spiked by as much as 50%.
Wow, 50%.
Yeah, and meanwhile, oil futures advanced right alongside it. You've got WTI April 25 up 1.0% and Brent May 26 up 1.4%.
The market is clearly pricing in a disruption. Now, with natural gas and oil surging like that, my first thought is the classic safe haven play. Did we see a rush toward gold?
We did see gold rise 0.6%, but it was actually tempered by a surprisingly strong U.S. dollar.
Which brings us to a really fascinating pivot, the currencies. The U.S. dollar index, or DXY, eased slightly, down 0.1%.
But that was only after broad safe haven gains.
Right, gains that completely overshadowed strong U.S. manufacturing data, the ISM PMI. You'd think global instability would shake things up everywhere, but the dollar is acting like a fortress right now.
Well, there's an aha moment here regarding why the U.S. dollar is structurally insulated right now. Analysts at ING pointed out 3 key reasons for this.
Let's break those down.
First, the U.S. just has a relatively lower energy import dependence compared to Europe and Asia.
Because they have their own domestic buffer. A supply shock doesn't hit them quite as hard at home.
That domestic buffer changes the whole game. Second, markets are actively trimming their Federal Reserve rate cut expectations.
Makes sense.
And third, there's a high risk of capital fleeing emerging markets. Rising energy costs make those investments much riskier.
So that puts major financial institutions in a really interesting position. JP Morgan is even recommending tactically unwinding long euro to US dollar positions because of this bearish outlook.
It makes complete sense when you look at how the rest of the world is weathering this.
So let's do a rapid-fire tour of how these global ripple effects are playing out, starting with Europe.
Over in Europe, the euro to US dollar rate recently tumbled from near 1.100 to below 1.1600.
Driven mostly by those energy disruption fears.
Yes, and right now they're just waiting on EU inflation data. EU bonds also slipped below 130.00.
Okay, jumping over to the UK. The pound to US dollar is holding relatively flat around 1.3400.
All eyes there are on Chancellor Rachel Reeves.
Yep, waiting on her upcoming spring statement to really shape fiscal expectations. And finally, Japan.
The US dollar to Japanese yen is steady around 157.00. The data coming out of Japan is mixed, but incredibly resilient.
Higher employment, but then upside surprises in corporate profits and sales.
Though it's worth noting, 10-year Japanese government bonds dropped significantly, down 59 ticks.
So, connecting all of this data, what's the core takeaway here?
The takeaway is that cross-asset performance is currently hostage to these geopolitical developments and the resulting energy-driven inflation fears.
It's all connected. So, as you watch these events unfold, we want to leave you with a final provocative thought to mull over based on today's source.
A big question for the days ahead.
Right. With energy prices surging and the U.S. structurally protected by its own energy independence, how long can energy-dependent regions like Europe and Asia actually withstand the pressure? How long before their economic resilience begins to buckle under the weight of imported inflation?
Something to keep a close eye on.
Absolutely. Thank you so much for joining us on this deep dive.